2-year back to 4.3.
Oh, it's huge. We jumped overnight 1.4% on the 2-year. We're back at 4.32. It's up six tenths of basis point. You had Bank of Japan, their CPI came out hotter than expectations. You also had Germany's, their flash PMI, hotter than expectations. Those PMIs, that's the trickle effect on the consumer, on those CPI data that comes out. And what that means is we're going to have inflation longer. Right now, you got this Qatar Economic Forum going on, and they're coming out. They're really, really hawkish on crude oil. They are like going to pump this thing back up. You got crude oil up $1. That's going to weigh in on the inflation data, and we're going to stay hotter for longer. So you had Kashkari. He said he doesn't want to declare that, raising rates isn't done, and that they're on a mission to get this inflation down. So, investors have moved up their bets here to a 30% chance of an interest rate hike at the next meeting versus 22 just yesterday.
Yeah, I think that's all a big part of what we've seen in terms of rates. Getting back to your point in terms of Japan, I saw the highlight of the week seems to be Tokyo's May CPI data. The headline, the core expected to ease to, it looks like, from 3.5 on a year-over-year pace. But I did see that it looks like excluding fresh foods, energies, we're talking about underlying measures seen to rise to a new cyclical high of 3.9% from 3.8. Talk to us about what I mentioned here in terms of my chart of the day, the divergence we're seeing as far as rates to the upside, investors shrugging it off, focusing on the positive, buying up the NASDAQ. You've got the 2-year back through 4.3 levels we haven't, last time we ran up through this level to this extent, it was the fall of last year. At the time, the NASDAQ was ripping down through 12,000. Here we are at 13.8 in this tech-heavy index. I mean, a bit euphoric, or, am I looking at this wrongly?
It's a total head scratcher because logically, all these tech companies borrow. They use short-term, lending. Yeah. So those higher interest rates typically weigh on the profit.
It's supposed to be a headwind. Yeah.
Exactly. That was an entire conversation that I had over the weekend with my partner Giannis. We were scratching our head on this thing. So I'm not sure. I think people are finding safety and they're looking for that Fed pivot, and that's going to be that tailwind for the NASDAQ. So it's already far ahead on that. Back on that Japan's up 16% year to date. It was Warren Buffett that woke up those stocks. That market trades at a 50% discount to the U.S. Their dividend yield is higher, and they have very little corporate debt. So Japan is a great place to be at. Greece is another one that was up 7% yesterday. They're up 31% year to date. So it's not just like some anomaly with, the NASDAQ. You look at all these other different countries and their tech heavy sectors, they're all rallying significantly higher. It's things like the Russell. If you're going to be bearish anything, you got to be bearish, the Russell. So you got the banking problems. But if you look at that Pac West, that thing hit 450. Now it's like, I don't know, it might be closing on an $8 while we're talking right now.
Phil, at risk of beating a dead horse, or I guess I should say trying to catch hold of a galloping one, a Mustang in many ways one could describe it as, the NASDAQ's been very strong. I'm kind of equating that to tech, right? You just mentioned, and our, the strong labor market, right? All of us need these tech gadgets, ultimately a software. Work from home is still a, big part of everyone's lives, it seems like, for the most part. That worst case scenario didn't really play out, it seemed like, in terms of the economy right now, a recession. Is there more to go? Again, I mean, if we continue to see these conditions remain, ultimately, a lot of naysayers, I've seen markets rally amidst that sentiment or that type of environment.
Yeah, we got the NVIDIA earnings coming out after the bell. That could be the one that kind of rattles the market a bit. But, I mean, they produce all the chips that are for, everyone's talking AI. So that could be that next bullish tailwind behind it. On the surface, it's really, this soft landing. Yeah, I think we're going to have better economic growth. I think the labor force is going to remain tight. I think that they're going to hold these interest rates higher longer. And, I don't know what is going to break the market. It just doesn't seem like there's some massive catalyst. This debt ceiling thing, I think that's just a circus. I think it'll get done. The can will get kicked down the road. So, there's nothing there that's like really going to rattle the cage at the moment.
Let's talk a little bit about the U.S. dollar here, because it has been firming up quite a bit with the move higher in rates. And as investors have kind of focused on the positive, kind of discounted the negative here. And, the greenback now right back nearing the middle of the range that we established last year.
Look, the bottom in the dollar was everybody was talking. They were flying into gold, flying into silver. They were saying that the dollar is done. It's over with. I don't know what would happen there, but when I look at the dollar, I look at it against everything else as a pair. So there are 5 other currencies out there against the U.S. dollar: the Aussie, the pound, the euro, the Swiss, that are all bearish trend right now. The Canadian dollar is the only one that is bullish trend against the dollar, and that's because of the proximity to the U.S. economic growth we have. Like 90% of that country lives within 100 miles of the U.S. border. We're their #1 trade partner here. So the Aussie is suffering from the correction in the metals and the minings and a slow start to the Chinese reopening. They do have an interest rate decision. There is a lot of talk that tonight they might go 50 basis points. The yen, that's another one that has a breakdown with no real flight to safety here. You got U.S. equities under pressure, and the yen just turned negative right now.
Yeah, yen into a new low for the year. As we could pull this chart here, I like the discussion in terms of looking at these products versus the U.S. dollar. I've got them here side by side. I've just looked at the Canadian dollar. Everybody seems to just only focus on the euro because, again, that large percentage of the basket of currencies that makes up the U.S. dollar is comprised mostly of the euro. But here you can see, and I would argue that a big part of what we're seeing in the U.S. dollar and the reversal off those lower levels, that retest to that 142 low that we saw the retest this month that we saw that failed, is a big part of that. I think you could chalk up to the yen that we're seeing. In terms of some of the other Asia-Pacific currencies, you mentioned the RBNZ. Obviously, we'll be keeping an eye out there for a rate hike tomorrow, I think it is. And I wanted to get a little bit more closer to home in terms of our foreign counterparties and Europe, UK. We saw a fair amount of data last night. We actually started the week off, Phil, talking about Christine Lagarde and some of the comments there. Very hawkish tone from her over the weekend relative to Powell, shifting gears a little bit with the hawkish tone from Bullard and Kashkari yesterday. But some of the data out overnight here, what are you seeing in terms of Europe relative to what we're seeing here in the U.S. in the data?
Well, it showed that a lot of their PMI data, their CPI data, it's all coming in real hot. So they've got to keep, the foot on the gas. They've got to try and get their inflation down. And it's going to it's not putting pressure, though, on the dollar index right now. Like I said, the dollar broke out of that wedge. So I don't know what's going to change the direction on the euro at the moment. They've got a lot of moving parts over there.
We'll definitely keep an eye on those numbers here. And Phil, we appreciate you joining us here for a solid breakdown, a look at financial markets here amidst multiple focal points for